Today, the silver market wakes up to uncertainty. Screens flicker red and green as traders sense unusual tension, signaling that this will not be an ordinary trading day. Overnight sentiment shifts rapidly, fueled by rumors, speculation, and global macroeconomic anxiety, pushing silver into a volatile dance between fear-driven selling and defensive buying. In major trading hubs, analysts scrutinize early price action, noticing sudden spikes in volume that suggest large players are repositioning ahead of potential market turbulence. Silver, often called gold's shadow, reacts faster and more violently, reflecting its dual role as both a precious metal and an industrial commodity. As markets open in Asia, prices jump and retreat within minutes, confusing retail investors who struggle to understand whether this movement signals opportunity or danger. Social media amplifies uncertainty, with traders sharing screenshots, bold predictions, and warnings, accelerating emotional reactions across the global silver community. Institutional desks remain cautious, aware that silver's thin liquidity can exaggerate moves, turning small shocks into sudden price swings. Economic narratives collide today, as inflation fears, interest rate expectations, and industrial demand all pull silver prices in conflicting directions. For long-term investors, today's volatility feels like a test of conviction, challenging beliefs formed during months of relative market stability. Meanwhile, short-term traders sense opportunity, preparing to exploit rapid movements, knowing that timing, not direction, may define success today. Historical patterns echo faintly, reminding veterans that silver often moves hardest when uncertainty dominates broader financial markets. As European markets join the session, volatility intensifies, with prices reacting sharply to each new economic comment and policy hint. Charts reveal long wicks and broken levels, visual evidence of a battle between buyers defending support and sellers pressing aggressively lower. Commodities desks debate whether today's move represents a temporary shakeout or the early stage of a broader trend reversal. Physical silver markets respond more slowly, but dealers quietly adjust premiums, anticipating potential supply stress if volatility persists. Industrial consumers watch closely, aware that sharp price changes could impact manufacturing costs and procurement strategies. Currency movements add another layer, as a shifting dollar influences silver's attractiveness to international investors. Some traders recall past episodes where similar volatility preceded explosive rallies, while others remember painful breakdowns that followed false optimism. News headlines offer no clear answers, reinforcing the reality that markets often move first and explain themselves later. As the session progresses, emotional trading becomes visible, with rapid entries and exits amplifying intraday price noise. Risk managers tighten controls, aware that silver's volatility can quickly exceed expectations, catching unprepared traders off guard. Despite uncertainty, liquidity remains active, suggesting that confidence has not vanished, but rather transformed into cautious participation. Retail investors hesitate, torn between fear of loss and fear of missing a potentially historic move in silver prices. Commentators describe today as a decision point, where silver may choose a direction that shapes sentiment for weeks ahead. As midday approaches, volatility refuses to fade, signaling that deeper forces are at work beneath the surface of the market. Seasoned traders remind themselves that silver rewards patience as often as it punishes haste during emotionally charged sessions like this. Technical indicators flash mixed signals, offering no clear consensus and reinforcing the uncertainty dominating today's market environment. Whispers of larger macro shifts circulate quietly, adding weight to every tick in silver's price movement. The market holds its breath, aware that a single catalyst could push silver decisively higher or send it sharply lower. By the end of this phase, one truth becomes clear. Today's silver market is not driven by certainty, but by tension, anticipation, and unresolved questions. Behind today's price swings lies a complex web of macroeconomic forces, quietly reshaping expectations across commodities, currencies, and global risk assets. Inflation narratives remain unstable, forcing investors to question whether silver should be treated as protection, speculation, or merely a volatile trading vehicle. Interest rate uncertainty weighs heavily, as shifting expectations alter the opportunity cost of holding non-yielding assets like silver. Central bank signals, though subtle, ripple through markets, reminding traders that policy tone often matters more than immediate action. Institutional investors analyze positioning data, searching for clues about whether leveraged funds are adding risk or quietly stepping back. Some funds reduce exposure, not from fear, but from discipline, locking in profits earned during earlier, calmer market phases. Others see opportunity, interpreting volatility as a gateway to asymmetric returns if timing aligns with the next decisive move. This divergence fuels internal conflict within the market, as conviction collides with caution, creating sharp intraday reversals. Technical traders identify broken patterns, while contrarians argue that such breakdowns often trap emotional sellers near critical levels. Sentiment indicators oscillate wildly, reflecting a crowd unsure whether to lean into fear or prepare for renewed upside momentum. Silver's industrial demand complicates the narrative, linking price behavior to manufacturing health and future economic activity. Any slowdown in production threatens demand expectations, while recovery signals reignite optimism almost instantly. Meanwhile, physical market participants monitor inventory levels, aware that paper volatility does not always reflect real-world supply conditions. Premiums act as a silent indicator, quietly revealing stress or confidence beneath the surface of futures-driven price action. Currency fluctuations intensify pressure, as a stronger or weaker dollar reshapes silver's appeal across international markets. For emerging market buyers, exchange rates amplify volatility, turning modest price changes into significant local cost shifts. Bullish voices argue that today's chaos represents accumulation, not distribution, pointing to rising volume during rebounds. Bearish analysts counter that volatility masks weakness, warning that failed rallies often precede deeper corrections. This clash of interpretations defines the session, with each new candle reinforcing belief on one side while alarming the other. Media commentary adds noise, simplifying complex dynamics into headlines that rarely capture the full scope of market reality. Experienced traders filter this noise carefully, relying instead on structure, liquidity behavior, and historical context. Risk appetite across broader markets subtly shifts, influencing silver indirectly through correlations and portfolio adjustments. When equities hesitate, silver reacts unpredictably, sometimes benefiting from defensive flows, other times suffering from liquidity withdrawal. Volatility becomes self-reinforcing, as wider ranges attract short-term traders who further amplify price movement. Options markets price in uncertainty, with implied volatility rising, signaling expectations of continued turbulence. Hedgers adjust strategies, seeking protection against extreme outcomes rather than precise directional bets. As hours pass, the market shows signs of fatigue, yet refuses to settle into any stable equilibrium. Participants sense that resolution may not come from technical levels, but from an external catalyst still unseen. Anticipation builds quietly, turning every minor data point into a potential trigger for the next surge or breakdown. By this stage, silver is no longer just a metal. It becomes a mirror reflecting uncertainty embedded within the global financial system. As liquidity thins, silver's movements grow sharper, with each price tick carrying greater emotional weight across trading desks worldwide. A sudden surge catches attention, forcing traders to question whether a genuine breakout is finally unfolding. Momentum indicators ignite briefly, drawing in late buyers driven by fear of missing the next explosive move. Within minutes, aggressive selling answers the rally, reminding participants that silver rarely grants easy victories. This violent reversal shakes confidence, triggering stop losses and accelerating downward pressure. Panic whispers spread quickly, amplified by flashing red screens and rapid margin calculations. Some traders freeze, unwilling to act, while others exit impulsively, prioritizing survival over strategy. Volatility reaches extremes, stretching intraday ranges far beyond what most models anticipated. Market depth collapses momentarily, allowing relatively small orders to move prices dramatically. Contrarian buyers quietly emerge, interpreting chaos as opportunity rather than threat. These buyers stabilize prices briefly, slowing the decline and restoring a fragile sense of balance. Social media sentiment flips rapidly, shifting from optimism to despair within a single trading hour. Commentators struggle to keep pace, revising narratives as quickly as silver revises its price. Technical levels lose authority as emotional flows override textbook market behavior. Options traders react defensively, widening spreads and adjusting hedges amid uncertainty. Volatility products spike, reflecting collective anxiety embedded in derivatives pricing. For long-term holders, the noise feels overwhelming, testing patience forged over years, not hours. Some recall past crises where similar chaos marked pivotal turning points rather than final collapse. Yet uncertainty dominates, as no signal offers absolute clarity in real time. A second surge appears, weaker but persistent, suggesting underlying demand refuses to disappear entirely. Sellers hesitate now, wary that pushing further could ignite a more powerful rebound. This standoff compresses price action, storing energy for a decisive resolution. Every incoming data point becomes magnified, capable of breaking the stalemate instantly. Tension becomes visible, not just in charts but in the body language of traders watching intently. Silver hovers near a critical level, where commitment, not prediction, will determine outcomes. The market pauses, as if collectively inhaling before the next decisive breath. Sudden volume erupts, breaking the silence and forcing immediate reactions. Prices move violently, confirming that indecision has ended, though direction remains fiercely contested. Traders act instinctively now, guided more by emotion than analysis. By the end of this phase, silver's volatility has reshaped expectations, leaving no participant untouched by the experience. As volatility cools slightly, the silver market surveys the damage, revealing winners, losers, and lessons carved by an unforgiving trading session. Liquidity returns cautiously, yet confidence remains fragile, shaped by memories of rapid swings and sudden reversals. Short-term traders reflect on execution quality, realizing that discipline mattered more than prediction during extreme conditions. For some, profits were earned swiftly, while others absorbed losses that will influence their risk appetite moving forward. Long-term investors zoom out, reframing today's chaos as a single chapter within a much larger silver market narrative. They recognize that volatility, while uncomfortable, often precedes periods of clearer trend development. Physical silver markets adjust quietly, as dealers reassess inventory strategies and premium structures. Industrial buyers revisit procurement plans, factoring volatility into future budgeting and supply decisions. Analysts begin rewriting forecasts, incorporating today's signals into broader macroeconomic expectations. Some interpret the session as confirmation of silver's strategic importance during uncertain economic cycles. Others caution that unresolved risks remain, warning against premature confidence in either direction. Volatility leaves a psychological imprint, shaping how participants respond to future price movements. Market memory forms quickly, influencing expectations long after price action itself fades. Risk management frameworks evolve, emphasizing position sizing and flexibility over rigid forecasts. Educational value emerges from chaos, reinforcing timeless trading principles learned only through. As attention shifts to upcoming economic data, silver remains sensitive, ready to react once again. Future catalysts loom, from policy decisions to shifts in industrial demand and global liquidity. Whether today marked accumulation or distribution will only be clear in hindsight. What remains certain is silver's role as a volatility amplifier within the commodities complex. Its unique dual identity ensures it will continue reacting sharply to both economic fear and growth optimism. Participants carry forward heightened awareness, knowing complacency is rarely rewarded in silver markets. Market narratives gradually stabilize, but underlying uncertainty never fully disappears. For observers, today offers insight into how markets behave under stress, revealing structure beneath emotion. For participants, it serves as a reminder that preparation matters long before volatility arrives. Silver settles into a temporary equilibrium, neither calm nor chaotic but watchful. The market waits, knowing that volatility rarely announces its return in advance. Every tick now carries memory, shaped by the intensity of this session. As trading desks power down, reflection replaces reaction. Today's silver market leaves behind no certainty, only perspective earned through turbulence. And in that uncertainty lies the essence of markets, where risk, opportunity, and human emotion forever collide.